Hello and welcome to Let's Talk Business. The benchmark indices ended the volatile session on a positive note today. Nifty rose above 50 points to shut near 18,600, while Sensex jumped over 200 points to end above 62,900 mark. My colleague Hiral Dadia joins us with all the market action.
A volatile day of trade is what we witnessed in today's session. However, we've seen Nifty as well as Sensex advance for a fourth consecutive session in a row from a closing perspective. We've almost ended at a 5-month high, and you have Sensex which has inched closer to the 63,000 levels yet again. From a Nifty perspective, 18,600 is what we've managed to achieve as well. There has been clear outperformance coming in from Bank Nifty in today's session vis-a-vis the benchmark indices. And from a sectoral perspective, it was FMCG that was leading the gains, whereas a lot of pressure that was built in by the metal counters as well. Broader markets, if you see the mid-cap as well as the small-cap index, both of them ended with marginal gains, and the breadth, however, was pretty much in favor of the bears. So there is some bit of sluggishness that is coming in, but it's interesting to see because Nifty is just 1.5% away from its all-time high of around 18,887.6 that it hit in December 2022. And if you see the last 3 months performance as well, Nifty has rallied almost 7%, whereas you have the Nifty Mid-Cap 100 as well as the Bank Nifty that have already hit a life high so far. In fact, if you see the Mid-Cap Index, it's risen by almost 10% in the last 3 months. So that clearly tells you the kind of outperformance that we are seeing from the broader markets. And it's the FI inflows that have been steady in the month of May that is helping the markets. Let's quickly look at the top gainers. ITC, the stock was trading ex-dividend as well as there are news reports indicating that there is the demerger talks are back with regards to the hotel business. So any few further updates will be crucial. HDFC Life, Bajaj Twins as well as Kotak Mahindra Bank were the other top gainers, whereas Hindalco, Adani Enterprises, Tech Mahindra, Tata Steel as well as Eicher Motors were the top losers. On the newsmakers end, you had a Marksans Pharma. The stock jumped the most in the last 21 months on the back of a good set of numbers that were reported. Heikel was up in trade as well on the back of Q4 numbers. Balakrishna Industries was under pressure on the back of brokerage downgrades. Campus Activewear, Specialty Restaurants, both of these trading under pressure on the back of a weak set of numbers. IGSec Heavy Engineering also saw a good day of trade on the back of earnings. And you had a Vedanta that declined the most in 7 weeks, as this is because the unit is encumbered shares for almost $250 million loan from Glencore. So these have been the newsmakers in trade today, but clearly there is volatility in the market. The underlying tone is positive as per what analysts are indicating, but you could see some bit of dips that could be coming in at higher levels on the back of the markets being in an oversold zone. However, analysts are saying that buy on dips should be the strategy that should be adopted. Back to you.
Thanks, Hiral, for that. And meanwhile, the Reserve Bank of India released its annual report for the financial year ending March 2023. Now, the central bank's balance sheet expanded by 2.5% this year, while its income was up by 47%. My colleague Vishwanath Nair joins us for more from the BQ Prime newsroom. And Vishwanath, over to you for the key highlights.
The Reserve Bank of India in its annual report for the financial year ending March 2023 has pointed out that it has had a bumper year as far as surpluses are concerned. The income part of the balance sheet that increased by about that was at about 2.35 lakh crore. That's increased by about 47% as compared to where it was last year. This increase in income has come largely because of foreign exchange management activities. There the RBI has earned a gain of about 1 lakh crore. Essentially what this higher income has helped the RBI do is set aside a larger contingency fund. A contingency fund is a fund that the RBI sets aside for unforeseen circumstances, situations which are outside the RBI's estimation, and the places where the RBI has to step in and support the economy. So that money is being set aside for this specific purpose. Apart from setting aside this large amount of money for a contingency fund, the RBI has also transferred about 87,400 odd crore to the government as part of its surplus transfer agreement that it has with the government. Essentially, the income rising has supported the RBI's surpluses, but on the expenditure side as well, the RBI has seen certain aspects of its balance sheet increase. So, for example, printing of notes, agency charges, as well as employee costs have all gone up for the RBI this year, especially employee costs, which has gone up by about 50%, 55% to about 6,000 odd crore. That essentially is because the RBI has to set aside a certain amount of money because people superannuate over a period of time. Many age groups are there within the RBI's employee ecosystem, and as these people superannuate, the RBI has to set aside a certain amount of money to take care of their benefits. So that is where the RBI's balance sheet for FY23 stands.
And India's corporate earnings are expected to rise at least 17% in the current year, with a likelihood of even better growth. That's what Goldman Sachs' Sunil Kohl says. While speaking to my colleague Neeraj Shah, he also spoke about the top sectors which are expected to drive growth in the coming few years. Listen in.
If you look at the first quarter, China, Korea, Taiwan, they were the best performing markets. Even year to date, if you look at the markets, it's basically Korea, Taiwan, Japan has been the outperformer, right? Then we came into second quarter, which is we mentioned about the April report. Our sense was that a large part of that adjustment seems to have already happened, and therefore, when you start to get into the current period, we think it's not as differentiated in terms of South Asia versus North Asia. You may start to see opportunities in both sets of the markets because large adjustments have already happened. So we're still sort of constructive on markets like Korea as an example, which is more to do with the memory cycle there and the fact that we are expecting an upgrade or MSCI putting them on watch list for DM upgrade. So that's kind of a near-term catalyst for the market. But at the same time, as I said, we also constructive on India as a medium-term market based on the strong fundamentals there. So I think it's not sort of North versus South or India versus China at this moment. I think that was pretty much the case from last fourth quarter and first quarter coming into the year. But I think from now on, the markets will be higher based on the underlying fundamentals, and the fact that India's fundamentals still looks pretty strong. It has been actually improving in the recent months. Makes us constructive on the markets.
Where is it that you're most constructive? Is it the consensus BFSI, which will draw the maximum earnings and banks out there? Or are there some other outliers as well?
Banks for sure. So banks is a large part of the earnings recovery thesis there. I think if you look at the current reporting season also, Neeraj, I think the market got into the earnings season thinking that the credit growth expectations were fairly low. People thought that the margins will moderate quite a bit. What we saw is that banks continue to gain market share from NBFCs and other players. And we saw basically, if you look at the credit growth numbers, they're still very high at 16% or so, right?
Yeah.
And our sense is that margins may soften a little bit, but it'll be much more gradual. And if you look at FY24 margins, you'll be still higher than the pre-COVID levels. And so our sense is that margins may still hold up for the banks, in which case you can still get decent 20% plus profitability over the next couple of years. And if you look at the recent sort of few weeks, we are now seeing consensus numbers for banks getting upgraded, right? So banks will be one part. But I would say a lot of the other domestic cyclical sectors are also contributing to the overall earnings upswing. So, for example, we are pretty positive on the overall manufacturing space, with kind of government continuing to focus on infrastructure. You have the bigger, which is I think medium-term thesis, but you have the bigger kind of the Make in India and the PLI schemes where we are seeing more traction on the ground, and I think that's also sort of contributing there. Cement also plays into the entire kind of the capex recovery cycle, and then within consumer, as I mentioned, the margin story. It's heartening to see that we are actually seeing volume growth improving for the consumer staple companies. And they're also, it's not that you need the raw material prices to go down materially below from here. There has been enough raw material cost decreases that happened in the last sort of 6 to 9 months, and some of the lagged impact of some of that will start to feed into margins as well. There is obviously commentary about rural turning the corner in terms of management commentaries. If you look at the rural FMCG volumes, they have turned positive after multiple quarters of decline. So I think there are definitely kind of signs wherein the rural economy is also picking up. We should also contribute to the overall earnings. So if you put all of that together, we think both banks, but as well as some of the domestic sector should be contributing to a decent earnings.
Moving on, in a major decision, the government has decided to grant waiver of interstate transmission charges, also known as ISTS charges, to offshore wind projects for 25 years. Now, the move is expected to ease adoption process for the promoters of green ammonia and green hydrogen projects. My colleague Vikas Srivastav gets us more details.
Yes, you are right. Government has given exemption of ISTS charges to offshore wind projects as well as green ammonia and green hydrogen projects for 25 years. The waiver of offshore projects will be for projects that will come up by 2032, and for green hydrogen and green ammonia projects it has to be before 2030. Now the projects that will come up after 2032 for offshore wind projects, they will have graded charges for 4 years. So any project that will come up in 2033 and 2034, they will be charged 25% of the tariff, whereas projects after 2037 will have to pay 100%. Similarly, for offshore, as in for green ammonia and green hydrogen projects, that will come up after 2030, they will have to pay graded charges, same amount, 25% to 100% in 4 years. So by 2035, projects coming up after that will have to pay 100% of the tariff. Now the intention of the government is basically to execute more and more offshore wind projects, which are like massive in size as far as the size is concerned. They are like 15 megawatt size, one turbine that can go towards charging of storage projects as well as generation of green hydrogen and green ammonia. The first bid for these offshore projects, government sources have told me that they will come up before June end, and it is expected that a lot of these power companies as well as other infrastructure companies are planning to bid for this. Thank you.
The other big story, India's Q4 GDP data is due tomorrow, and the Bloomberg poll suggests that economic recovery is on track for the March quarter and will be led by services. Economists' poll also suggests that green shoots are visible in some sectors. My colleague Pallavi Nahata joins us with these details.
The Indian economy's growth recovery remained on track in Q4 FY23, led by growth in services. GDP is estimated to grow by 5% in the January-March 2023 quarter, a modest step up compared to 4.4% in the previous quarter. This is according to a Bloomberg poll of 44 economists. GVA is expected to have grown by 4.9% compared to 4.6% in Q3. For the full year, GDP is set to expand 7%. Now let's have a look at some of the key components and how they are expected to have fared. Agricultural GVA, higher acreage, early sowing, healthy reservoir levels and improved availability of fertilizers are likely to have helped Rabi output in 2023, according to a research note by ICRA. But unseasonal rains are likely to have dampened yield of some crops. Industrial GVA is expected to have improved, with manufacturing GVA likely to have registered a growth after contracting for 2 previous quarters, this time benefiting from higher volumes as well as lower margin pressures. Domestic demand for services continued to outpace demand for goods. Services exports remained surprisingly robust amidst a contraction in merchandise items. Now moving to expenditure trends, consumption recovery was supported by urban areas, but rural consumption is now showing nascent signs of recovery as real rural wage growth turns positive. The drag from net imports is expected to be lower, with reduction in trade deficit and a surge in services surplus. Capex cycle recovery, which depended on central government expenditure so far, got some support from pickup in state government expenditure and an improvement in capacity utilization. This is according to a research note by IDFC First Bank. GDP figures for India are set to be released on Wednesday. Stay tuned.
That's all we have for you in this segment. Thanks very much for watching. Goodbye.